I've been in real estate, since '06. We primarily did a lot of flips, but then we also did lots of multifamilies. And I have never, embarrassingly, I've never done a cost seg. And I don't know why. I just don't think it's that well known out there. Maybe better now than it was back then. But, like if somebody was looking at their property, they're standing in front of it, they're maybe sitting in it, like how do they determine whether or not a cost segregation study would benefit them or just be a complete waste of time?
Well, I've kind of distilled this. Now, there are many, many reasons, but most of them don't apply to the real world to lots of folks. For example, I'll throw this one out. If you belong to a syndicate and the ownership of a building has 500 partners, well, I would say probably for the 500 partners to get a consensus about how to handle taxes would probably not be a strong idea just because of that, the way that the building is owned. But I'll distill it down and tell you, I'm going to be a little facetious, but I'll start off with number one, which is facetious, sarcastic, is that if you're not paying any income taxes, you don't need to call Joe. So that's number one.
Do you really, I'm sorry, do you really have to tell people that?
Oh, yeah. People are so excited about what I do, and I call them up and I go, well, what's your combined income tax rate? What do you mean? What's your tax rate? You must know that you're state and federal, you're combined. And they're going, well, I don't pay taxes. It's like, well, why are you calling me? You don't need to call me because you've got the best world right there. If you're not paying taxes, you don't need to call Joe. So that's
listeners, like, yeah, if you're not paying taxes, like, don't go any further. Like, don't get excited about this.
But here's the deal, though. There is most people who don't pay taxes, maybe in the future they might. So listen up, guys, because you want to know about this strategy because it is really the one that's accepted by the IRS. So number two is going to be those who was probably maybe the reason you shouldn't have done cost seg is you have to be a holder of real estate. So there's a concept called depreciation recapture. And because of depreciation recapture, my advice, and I'm a lot more liberal on this because I talk all around the country and I have a lot of CFOs of very high powered real estate developers. And I ask the CFO, okay, what's your hold time? So I've distilled it down to 1.5 to 2 year hold. If you're a flipper, you're not going to meet that criteria. I will be the first to tell you, don't give me any money to do cost seg because really the money I save you in taxes, you're just going to have to pay it back. So why go through this exercise and pay me a fee and get me all the information I need, which isn't a lot, but give me my information. I tell them you're better off not doing it. Now, one segue at this point, we can get into it deeper, which is a really good thing for clients to know is cost segregation does reduce depreciation recapture. But again, it's for those that are planning to hold the building at least 1.5 to 2 years.
Yeah, that's not that long. And I think a lot of people right now, flipping's been a tough business. It really has in the last couple of years. It's only going to get harder. I mean, right now, hard to find inventory, hard to make a spread, cost of goods, and this everything required to rehab has just gone through the roof. It's a tight spread right now. So I think a lot of people are going to this model where they're buying the properties, renovating them, but they're holding them as rentals. It was commonly before interest rates skyrocketed, it was, the BRRRR model, and now the BRRRR model kind of burned, more or less. So I think a lot of people are holding single family rentals, whether it's midterm rentals, short-term rentals, and all that. So all we need is about 2 years, 1.5 to 2 years of hold time, and this starts to pencil.
Now, it depends on your internal rate of return. If you're going to tell me that you're going to take the tax savings, let's say I save you $30,000 in taxes on a single family home, $50,000, whatever it is, a relatively small amount, because, if you own a building like a multifamily that's worth millions of dollars, I'm going to save you hundreds and hundreds of thousands of dollars. But let's say single family home that I'm going to save you $50,000 in income taxes. It depends on what you're going to do with the $50,000. If you're going to put that in a savings account in a bank, I'm going to say don't do it. I'm going to still tell you don't do it because you need to make money on the money. And most of my investors, their IRR, I hate to say this, but my investors are all pretty good. So I would say their lowest is 20%, but I'm not shocked at 60, 70% IRR. So what does that mean? That means if I give you a dollar today and you can double it in a year and a half to 2 years, definitely do cost seg. But if I give you a dollar today and in 2 years your dollar's $1.10, you made 10 cents, I'm going to say don't bother because it's the time value of money. That's what we're doing. The same depreciation, you're going to get the same depreciation over the life of the property. For residential, that is 27 and a half years. For commercial and Airbnbs, because Airbnbs are hotels, that's 39 years. So bottom line is at the end of the 39 or the 27 and a half years, I'm going to give you the same amount of depreciation. So there's no smoke and mirrors. All it is, I'm giving you the time value of money. You want this big deduction today because the dollar today is worth a hell of a lot more than the dollar in 27 and a half years. And what I would want everybody to do with that dollar is either buy more real estate or fix up their properties, improve their properties with the money that I save them. Now, you can do what you want. You can go to Europe. You can, take care of your retirement. I really don't care. But again, I'm big on real estate. And again, a segue back, why some people don't pay income taxes is because real estate is so powerful. There's a ton of other tax strategies out there. So it doesn't shock me when somebody says, I don't pay income taxes. I just think, okay, they got something cooking. They're probably very good at it. And great, call me when you need me.
Yeah, I think, my audience, you're speaking to the right audience here. First off, I mean, that's all we do is teach people how to keep their money working for them and how to be in control of it. And everything you're talking about, number one, gives them control back of tax dollars that they don't have in their hand so that they then can take that money and send it out to work again at a higher return. So this audience, a couple 100,000 of them, this is ringing true to them. I can guarantee that. The thing that I think is so important, and I'm going to reiterate this, we said it earlier, I'm going to hit it again because it's so vital. When you think cost seg, most folks, and I guarantee you watching this right now, you're thinking big apartment complexes because that's usually what we hear. We hear, oh, this syndication, this 100-unit building, like we're going to do a cost seg. But how many of you have heard of cost segs being done for that single Airbnb that you just bought during the pandemic? And here's the other thing. That Airbnb used to make you a bunch of money, but now that's kind of softened a little bit. So now it's not making you as much. So right now might be a really good time to look at this strategy because if you're not making as much in your Airbnb off the rents, maybe this will give you the ability to claw back some of that money that you've been waiting for. I don't know. Joseph, what do you say to that?
Well, okay, here's another little known. Well, I shouldn't say that. Here's another fact that people must understand is that you can go back and you can use your extra depreciation for cost seg and get a refund on taxes you paid. I believe you can go back 3 years.
Wow.
And get a refund. Now, very few of my clients do that because they're good investors. And if you go back and get a refund and you're going to have to pay more in income taxes at the end of the next year, then it's a wash. And I say, why bother getting a refund if you're just going to have to pay it back next tax season? So, it may not work, but you can get a refund. You can go back 3 years and get a refund, which is, a lot of clients don't know that. So maybe you're not going to pay income taxes this year, but if you paid them past 3 years, go back and get that money.
Yeah, no, I like that. And, I'm not speaking for everybody here, but I know a lot of, our clients, they're paying a lot in taxes. I don't know how many we have that aren't paying any in taxes. I mean, maybe, but I think a lot of them are really paying a bunch in taxes because we brought people on, regarding trust planning and 1041 planning and all sorts of things, and that's a big hit. So I think this is going to be also a big hit. So what else do people need to understand when thinking about this strategy and about a cost segregation on their properties?
Okay, so let's segue for a minute because we're in a unique position. When I first started, we only did one style of report. And our model for U.S. Tax Advisors Group Incorporated, or USTAGI, is basically we follow the Audit Technique Guidelines, ATG, for cost segregation published by the IRS. So if you go on Google and do ATG for cost segregation, you'll go to the IRS website and you'll find I think it's a 250-page document. That's my Bible. I followed that to the letter. It's a guide to IRS agents telling the agents what they need to look for when they audit cost seg. So I do everything according to the book. So why am I mentioning that to you? Because I think what you need to do is you need to find uh, some entity out there, because they're everywhere. I know my market very well, but a lot of these guys and gals just don't really do everything according to the audit technique guidelines. One of the several methodologies recognized by the IRS is called a modeling technique. And so what happened in the top one is called the detailed engineering. The detailed engineering just means that we go out to the property, we document the property, meaning we take pictures, we measure all of the property, both the long-term property, the 27 and a half, and the 39-year property, and the shorter life property. So what's a short life property? In the interior, the 5-year property are things like window coverings, flooring, specialty lighting, cabinets, countertops, sinks, etc. Outside the property is 15-year property, and that's going to be all of your landscaping and all of your driveways and fencing and swimming pools and those kind of land improvements. So you've got 5, 15, and then the real property. You've got the main chassis of the building that stays in the real property. So we are just peeling off the personal property and the land improvements to get the acceleration effect. Normally, don't hold me to this, but normally about if someone can figure 30% of the building basis. So the building basis is what you paid for the building, not what it's worth, what you paid for the building less the land. And so if you want to do your own estimate, just figure about 30%. If I give you a written estimate, it's going to be a lot more conservative, because I believe in being very conservative, but you can figure in your brain about 30% and decide if you have a single family home that you paid 120 for, and you 20,000 is going to be land, and now we have 100,000. Figure that Joe will give you about a $30,000 new write-off against your taxes. And of course, any write-off against your taxes decreases your taxable income. So voila, that's what we're going to save our clients is the income taxes by giving them a higher degree of write-offs. So bottom line is, what we did is we went out there and we measured everything back in those days. But we knew that there's a lot of smaller buildings out there. We could only afford to fly out to Buffalo to do a property in Buffalo if it was a big property. What do I mean by big? $1 million plus. Well, there's a ton of buildings out there, single family homes, duplexes, blah, 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 that are a lot less. And so bottom line is, we came up with a technique of ours where we are doing a modeling or analytical review of the property. That means we're not flying out there. That means we're getting the information from you. And what would that be? Well, maybe pictures, definitely an appraisal, definitely any documentation you have on the property. And our experience and our database of properties that we have allows us to go in there and say, okay, I'll pick on Buffalo again, a 3-bedroom, 2-bath house in Buffalo, New York. This is what is expected to be found in 5 and 15 and 27 and a half year property. So what we do is we give the IRS the analytical approach. Well, what does that mean for the taxpayer? We charge $625 for current year modeling studies. We charge $675 for look back. And you're going to say, what's a look back, Joe? We can go back 15 years and still make the numbers work. If you do a look back study, you're going to have to tell the IRS you've already used another method, and somebody has to do the calculations of how much depreciation you took, how much new depreciation you're getting from cost seg, and do the math. We do the hard lifting. We do the math. Your accountant will need to file the form. It's called the 3115 change of accounting method form. They need to do that. We can help them, but we don't sign tax returns, so we can't fill out the 3115. But we do give you, for the extra $50, we will give you the what's called the 481A adjustments. And so we're one of the few out there that give a really high level report. What do I mean by high level? Meaning, even though it's an analytical report, we're still giving you a lot of detail.